Hi, everyone. We are going to get started in about 2 minutes. We are just allowing a few people to join before we kick it off. Hi, everyone, and welcome to our webinar today. Before we get started, a few items just keep in mind. First, on the right side of your screen, you will see a question section. Throughout the webinar, you can submit questions that you want Ed to answer at the end of the webinar. Second, we will be recording this webinar, so at the end, we will be emailing you to share with your colleagues and to listen again if you're interested. So to kick it off, I would like to introduce Patrick Roberts, who is the Director of Lender Strategy at MountainSeed.
Great. Thank you, Hillary. So yes, this is Patrick Roberts, Director of Lender Strategy over at MountainSeed, and excited to be talking to everyone today. Want to give a quick introduction on MountainSeed for those on the call that are not aware of all the things we do over here. But predominantly, we are a collateral due diligence firm working with financial institutions across the country. We have a client located out of every state, roughly 500-ish financial institution clients. And we also work on a number of different other initiatives, including property tax appeal for bank branches, as well as for OREO for banks. And then in conjunction with that, we also have a couple different fee generating type initiatives that can help banks find fee income. So with that, very, very excited to have CenterState Bank participating today. They're a long-term client of ours. I want to introduce over Ed Kaufman, and Ed will be speaking today on how to attract and retain commercial relationship borrowers. So with that, Ed, I'll turn it over to you.
Well, thank you, Patrick. I'm excited to spend some time with everybody on this webinar. And because I've been married for 16 years with 2 kids, I'm also surprised that anybody actually wants to listen to me. I don't get that treatment at home. Let me tell you a little bit about my background and about my institution. I worked at Wells and B of A and other national banks for more than a decade. And then I went over and started working with smaller banks, community banks, regional banks. And until that time, I had no idea there were banks under $200 billion in assets. My exposure in banking was all to the national banks. It was very eye-opening. At CenterState, I work with banks around the country. We have over 600 correspondent relationships. I also work with my own banking team members. We have over 160 commercial lenders. And this particular topic of what is a relationship account, how do you attract relationships, and how do you retain them at the bank, I live that day in, day out, both with the bank and our lending team, but also with community banks across the country. And so with this presentation, what I'd like to do is define what a relationship customer is, also talk about how community banks should measure relationship profitability generally. We'll talk a little bit about service because every bank I go into tells me that they're above average in level of service. look at some parameters of how to define service and how to compare it to your competition. And then equally importantly, in the context of relationships, how do we differentiate our bank offering, the consultation that we provide, the services, the products, how do we differentiate from our competitors? So I'm going to cover all of that, and I'm going to do it through some empirical evidence, so research that we've done. I'm going to tap some other consulting firms in their research, but most importantly, through the experience that we gain at CenterState, working with our own lenders and banks across the country. So I'm in Dallas today, so it is about 1 p.m. Central Time. I've already had 3 conversations, multiple emails, but 3 conversations with bankers across the country, and all 3 highlighted important facets of relationship building. So what I'm about to share, I live day in, day out. Okay? So first, by way of background, to set sort of common standard, this is a graph, and it's a little busy, but I'll define it for you. It shows all the banks in the country and their 10-year ROE performance. The bank's ROE is represented by this orange line. So we have 5,900 banks approximately at the point in time. There are banks who have a negative ROE over that 10-year period, the span. And then we have the average banks all through the middle here. And then on the far top right, these are the top performing banks. Their ROE exceeds 20, 30, in some cases even 50% on a 10-year horizon. But the average community banks, or the average bank's ROE across the country is 7.7%. The average bank's cost of capital is about 11%, and that's represented by this green line. So what this graph concludes for me is that most banks in the country do not earn an ROE sufficient to pay back the shareholder return. Now, some bankers will say, well, I really don't care. My bank is privately owned. We like running a bank. We like being involved in the banking industry. And that's fine. That can keep the management team and shareholders attracted to the business for 1 year or 2 years or 3 years. But in the long term, it is very unlikely that these bottom banks that are not earning sufficient return on capital. The minimum hurdle, in our opinion, is about 11%, depending on what the treasury rate does, the volatility in the industry. But roughly 11%, if banks are not earning that return, over the long term, banks are going to find partners or go out of business. And no doubt, if you look at historical bank charters, that's exactly what we find. Here's the number of banks from 1992 to end of last year. And we've seen a 61% decline in total number of commercial and savings and saving and loan institutions in the country, 61% over that period. And that's a rapid decline. But what is more telling is that regardless of the period, the decline has been relatively steady. So if you look at the golden age of banking, when all of these de novos were formed in 2004 and 5, banks were still declining in number. And then when you look at the Great Recession, 2008, 9, 10, banks were declining, but not a visibly higher rate. This line is relatively uniform and steady, and I wouldn't take it all the way down to one bank, but if you extrapolate, we're looking at 2,000 banks in the next 5 to 10 years. And how do I connect that to relationships? Here's how I connect it. Historically, most banks paid lip service to relationship, but never actually measured it. They did measure one parameter, and that's net interest margin. Every bank I go to spends an inordinate amount of time measuring and managing net interest margin. Relationships are not measured. Everybody says they want relationships. How do you quantify it? How do you incent people to bring relationships? How do you retain those relationships? Typically, not a lot of effort or resources has been allocated to that. So I'm going to play a game with everybody on the webinar today. I want you to have a little piece of paper. I've got one in front of me. It's a really simple game. You're going to put door A or B. We're going to play a game. I'm going to give you two loans. You don't know anything about the loans except the following. You're going to choose door A or door B. Behind door A is a loan that was booked in the last 12 months at an index of 1 month LIBOR plus 150. That's door A. And door B is a loan that was booked in the last 12 months at an index of 1 month LIBOR plus 325. And I'd like everybody on the webinar to write down on a piece of paper whether you choose door A or B. You know nothing about the credits except that there was a willing lender and a willing borrower because there were loans that were actually booked. There were loans that were done. And you know that loan A was priced at LIBOR plus 150 and loan B was priced at LIBOR plus 325. So please write down which one you would take. This is going to be important in how we view relationships. Relationships is driven by partly credit quality, partly loan size, the service that we allocate to retain the relationship, and the interest risk, both taken by the borrower and the lender. Many banks don't measure any portion of this relationship, but they do measure net interest margin. And I'd like to show you how net interest margin drives performance. Here is a graph scatter plot diagram showing all the banks in the country, and I took it over a 5-year period, so it's the average ROA. So you've got ROA on the y-axis, net interest margin on the x-axis. This is all the banks. So your bank, if you're a banker, you're on the phone, your bank is one of these dots over here. If you think that net interest margin is important to measure, I would infer that you believe that net interest margin drives performance. But nothing could be further from the truth. The correlation coefficient between net interest margin and ROA is it's practically zero. It's negative 0.02, which is really zero. That means the banks that have a higher net interest margin do not show a higher performance measured by return on assets. Now, this is really confusing for many bankers when I show this. And some bankers walk away saying that Ed guy, boy, he's crazy because he wants us to do lower margin loans, and that's not what I'm saying. What I am saying is that when you have two loans and one has a lower yield and one has a higher yield, there's a reason for that. There's a market-driven force for it. And so over the long run, banks that have a higher net interest margin really don't show higher ROA. And in fact, when I look at defunct banks, so 10,900 of them approximately, these are banks no longer in business. And I do the same analysis and look at net interest margin versus ROA. Same thing, net interest margin doesn't drive performance. In fact, it's negatively correlated, slightly, which means that higher NIM actually resulted in lower performance for banks. Okay. Now, it's always important to put competition in context. So when I go out to banks and I say, who are you competing against? That is a loaded question. I already know who they're competing against. The real answer is everybody. But a lot of bankers will point out, well, I don't compete against JP Morgan. I never see Citibank. I don't see B of A in my market. Instead, I see Community Bank XYZ, and sometimes that regional bank is there, but not the big banks. Nothing can be further from the truth. Here's a concentration diagram. This is cumulative percentage. How many banks control what percentage of the loans in the country? 12 banks control 50% of all the loans, 23 banks, 60%, 120 banks control 80% of the loans. The point of this is that even though your community bank may not see JP Morgan, which is in this bucket of 12, you may not see Wells Fargo, you may see BB&T, and BB&T competes against B of A and Wells Fargo and JP Morgan. And so their behavior is driven by the national banks. And even if you don't see BB&T or SunTrust as an example, you may see Frost. And guess what? Frost competes against BB&T. The point of this is that 121 banks control the vast majority of the loans in the market. De facto, every community bank is competing against the national banks, which means that your rationality for loan pricing, your credit perspective, your relationship paradigm, it has to withstand your competition, and your competition are large banks, and they're sophisticated, and they're driven by relationships. So what is relationship? So I'm not reading this. The whole idea of putting this up is just to prove to you that we've done our analysis. We did a lot of research. We do a lot of writing. We publish blogs. We analyze the difference between transactional business and relationship business in banking. And I want to be very clear that transactional business can be very profitable. There are many community banks in this country that do not subscribe to relationship banking that are very profitable. Unfortunately, there are many more banks that are unprofitable because they cannot do relationship banking correctly. So I just want to highlight a few things about relationship banking. By the way, when I joined CenterState, and the question was posed, are we relationship bankers? Are we transactional bankers? Everyone said, oh, absolutely, we're relationship driven. When we looked at our portfolio based on the parameters I'm going to cover with you, we came to the conclusion we're not that relationship driven. We're about 50-50. Half of our commercial portfolio was completely transactional. I'll explain what that is in just a few slides. So just a few points on this particular busy graph, and that is in relationship banking, it's not a risk for reward banking. This is adding advice for client, providing a service that helps your client succeed. Okay. Very important, it's about lifetime value. To be a relationship banker, you need to have the customer at the institution for a long time. We'll consider what long time means. And the service that you're providing, the products you're providing have to be sticky, and you need to be able to cross-sell. And we'll talk a lot more about that in a few slides. This is my home slide. I'm going to start off from here. And let's define what relationship banking is. So on the left side here, definitionally, what is relationship banking? It's owning as much share of the wallet as you can. And in community banking, that typically means, not always, but typically 100%, meaning that if you bank IBM, which I have at previous organizations, we had maybe at B of A 5% of their total business. So if you look at their treasury management, foreign exchange, loans, deposits, everything we did for them around the world, we may have had 5% of their share of wallet. In community banking, banks should be striving for 100% of wallet. If you're a community bank and you've got 20% of wallet, that means there are 4 other banks. You're not a relationship banker to that particular customer. That's transaction business. So community banks should be about gaining the most share of that client's wallet they can gain. The next definitional is lifetime value. So what is important about lifetime value? Every loan that we put on the books in day one has negative ROE, represented by this graph. Why does a loan have a negative ROE? Because on the first day that you booked the loan, you had all the acquisition costs, all the sourcing costs, you wined and dined the client, you underwrote the credit, and guess how much you gained in revenue? Zilch, zero, nada. There was no revenue yet. People say, well, I got the loan origination fee, that's amortized, it's insignificant. There's a huge cost to build the onboarding, and only over time, as you clip coupons, do you then recognize a positive return. This is primarily why relationship banking is so important, because you want lifetime value. And the longer you have, the more profitable the business is from many perspectives, but certainly because you're clipping coupons. Now, what you also want to do in a relationship is stem defection. So anytime the customer leaves for a better deal elsewhere, you're jeopardizing your green, your positive ROE. So in relationship banking, we want to maximize lifetime value. The other thing we want to do is cross-sell and upsell. So upsell is to sell more of the same product. Cross-sell is to sell other products or services. Now, definitionally, I mean, you're not going to find this in a book anywhere. Relationship accounts must be profitable. Okay, so in this presentation, I'm saying that you must have profitability in your relationship accounts. Otherwise, you shouldn't have them. You should let them walk out the door. Everyone is familiar with the 80-20 rule. 80% of revenue is generated by 20% of your clients. It doesn't apply in banking. I know it comes as a surprise for many. Studies, Baker Hill, S&P, at CenterState, we all have done these studies. The numbers may be different. What we've concluded is that 10% of community bank customers generate 120% of profit. And people say, well, Ed, your math is off. How can you have 120% of profit? Well, that's because the other 20% of the business detracts, the other 80% of the business detracts 20% of the profitability. So there's a huge amount, 90% of your customers actually have a negative ROE. So the idea of relationship banking is allocating your scarce resources, your capital, your services, your consulting skills to your profitable customers. And then finally, back to my home page, it's institutional, not personal. Many bankers think that relationships are the people that you know really well. I went to school with Joe, and then now he's a farmer, and I know him really well. That doesn't work, and here's why. I talked to lenders across the country, and I talked to one a couple of weeks ago, and he was telling me he's such a great lender. He's had long-term relationships spanning 10, 15 years. He's had 5 different institutions he's worked for, and every time he jumps from one to the other, his relationships come with him. Now I'm thinking, well, that's great for you as a lender, but as an institution, how's that a relationship? That's your relationship. That's not the bank's relationship, because you've switched jobs every 2 or 3 years. When I hire you, you're going to be at my bank for 2 or 3 years. And when you leave, you're going to try to leave with all of these borrowers with you. That's not a relationship account for the institution. So it has nothing to do with the relationship that one individual has with the borrower. It's the other defining factors that I mentioned. So how do we find these relationships? Okay, let's go on to this next square here. Well, what we want to do in a relationship account is actually help our borrowers. But we can't help everybody. We can't be all things to everybody. We want to identify those customers that are strategic to us that can become relationship accounts. Now, which ones are those? Well, they have to be profitable customers. Their business has to be profitable. If a customer is not profitable, it is virtually impossible for a banker to make a profit off that customer. It is very, very difficult. I'm not saying that we shouldn't service unprofitable businesses, but going into it, eyes wide open, it's not a revenue generator for the bank. Okay. Secondly, we identify, and I'll talk more about this in just a moment, the customers we want to do business with. These are the ones that there's an opportunity for us to add value. We know their business, and I'll talk a little bit more about that in the next slide. We actually have products that we can sell to them. We can differentiate what we're offering them. And lastly, customers that are likely to do business with our bank, for example, IBM, if CenterState, as a $16 billion institution, we may say, IBM is profitable. We've got some services, but will IBM want to do business with us? Very unlikely. They have different access to capital and different institutions they use, and it's very unlikely that that's a good fit. So it's important to make sure that it's a profitable client we can add value to, and they want to do business with us. If you are not doing this, you're not being proactive, identifying your clients, guess what's going to happen? You're going to be reactive. Clients come in the door, and you're going to underwrite and do business with unprofitable customers, customers you really are not adding value to, and customers that don't really want to do business with you potentially. They're using you as a temporary source until they find someone else to go to. So if you're not proactively searching for this, you're going to be reactively taking whatever is coming in the door, and here's what could happen. Now, this is an array of industry segments that we have identified at CenterState, and you're going to have your own. Every bank will have their own. We generate more profit off accountants, private schools as an example, than trucking companies or tour companies, etc. Now, I don't want you guys to get offended on the phone because your bank may be doing a lot of very profitable trucking and tour company businesses. That's fine. It doesn't work for CenterState. So every bank needs to identify where can we add value and where can we earn a profit, and then go out and identify customers in those industries proactively. Because if you don't, guess who's going to walk in the door and take your loan? The trucking company that's going to have a negative ROE, versus if you're proactive and say, I got 163 lenders, let's concentrate on these top 6 industries where we've shown our ability to earn good profits. Okay, let's go back to our home slide. So how do we maximize these profits at equal risk? So now I'm going to give you an answer to the question, door A or door B. Okay, so 98% of bankers that I talk to choose door B. And the reason they choose door B is because that's the loan at LIBOR plus 325 instead of LIBOR plus 150. I would choose LIBOR plus 150 any day. Now, you didn't know anything about the 2 loans, but I'll tell you about these loans right now. The LIBOR plus 325 was a smaller credit, about $460,000. The LIBOR plus 150 was a $4 million credit. So everybody knows that larger credits are more competitive because we have the same overhead to underwrite them. And so we'll talk in a few more slides about how size can augment profitability and lead to better relationships for banks. So that's one thing that distinguishes the 2 loans. The other was the LIBOR plus 325 was a gas station deal where the 2 sponsors had a checkered credit history. The LIBOR plus 150 was a stellar credit. Right? So the credit quality is different. Okay. The other difference is that the LIBOR plus 325 was a transaction business. It's just a loan. There's nothing else associated. The LIBOR plus 150, door number A, had a loan that was $4 million, but guess what? It came with $14 million in deposits. Now that I gave you all that information, you see that loan A is the relationship account. It's in fact more profitable. But what I gave you were two wide goalposts. Loans don't usually present themselves so starkly differently. And so most loans that come in are pretty close to each other. And it's the banker's responsibility to decide which loan to take. Now, here's a graph showing risk return. And if you're a transactional bank, you would always say, and many banks fall into this trap, they say, Ed, well, I'll do the higher margin. I know it comes with a little bit more risk, but I'll do the higher margin loan. I'm focused on net interest margin, on NIM. Here's the problem. If you believe that the market is perfectly efficient, meaning that you've got this line, you have a risk-return trade-off, then any loan you'll do is equally good because you'll get higher yield, you'll take more risk. Over the long term, it's going to balance out. But the market is not perfectly efficient, and here's why. There are going to be banks that underprice risk, and occasionally there will be an opportunity to overprice the risk as well. But on a risky credit, where do you think the mistakes are made? In the low risk segment or the high risk segment? In other words, you don't want to be in the red. You want to be in the green. You want to get paid more for the same risk. But if you've got a loan that's on this side of the risk spectrum, and you've got a loan in zone 1 on this side of the risk spectrum, which one would you prefer to take? Well, I can tell you, mistakes are more likely to be made here in zone 2 by banks than zone 1. Think of zone 1 as a treasury. How far off will you make a mistake on the credit analysis of treasury? Well, there is no credit risk on treasury. You may be off on the pricing. There may be a bit off for spread. The broker-dealer may charge you a little bit more, but you're not going to make a mistake in the risk. Somewhere in the middle, there are commercial loans, and somewhere on the far end, there's mezzanine financing or unsecured debt. It is always easier not to make a mistake on a LIBOR plus 50 loan on the credit side than the LIBOR plus 325 loan. Especially in today's environment. And I'm not going to spend a lot of time on this. I could spend a whole hour. I'm not going to. Credit risk. I'm going to share something with you. In my opinion, the standard 120 debt service coverage ratio, 75% LTV, is now a substandard credit from the moment you originated. Bankers will say, that's impossible, Ed. I've been doing business in banking for 30 years. We've always done 120 minimum, 75% LTV. That's my bread and butter. Well, let me show you. The top panel here shows cap rates, all categories across the country. I've got them by different loan categories, hospitality, multifamily, etc. Look at where the cap rates are today. They're lower than where they were in the frothy period of 2006. In other words, the prices of real estate, the collateral we're taking to secure our loan, has never been so overvalued as it is today. And by the way, a lot of banks lost a lot of money lending in this time frame when cap rates were low, a little bit higher than they are today on average. Obviously, every region, every category is different, but we're now facing the lowest cap rates in the history that we've tracked them. So average cap rate is almost 8%, all nation, all categories. Right now, it's under 6%. So the 75% LTV, it may have worked when cap rates were 8. It's a substandard loan today. The other problem is interest rates. So your debt service coverage ratio, well, 120 has always worked for me. Well, yeah, when here's the 5-year hedge rate going back in history to 1988. So if you start off here, rates can come down a little bit, they can go up a little bit. Look at where we're starting here. This is almost as low as they've ever been outside of a terrible recession. So now we're starting off, rates could go down, debt service coverage ratio could improve a little bit, but if you're a student of finance or you believe in statistical reversion to the mean, it is more likely that rates go up, same NOI, your debt service coverage ratio of 1.2 is no longer any good. Banks need to move to debt yield. And I can tell you, I talk to banks that do relationship banking really well and those that don't pay any attention to it. Debt yield is a big factor in underwriting for relationship-driven banks. So here's an example of the same loan. It's the same collateral, same NOI, but different loans. One is structured at 122 debt service coverage ratio, 71% LTV, and almost every banker that I know would say, not knowing anything more about it, that fits our policy perfectly. That's a good loan. This loan right here has an 8.4% debt yield. And the debt yield is nothing other than NOI divided by loan amount. And this loan would be underwritten by most banks across the country. Banks that look at debt yield in today's market, they want a minimum 10% debt yield. Here's the exact same piece of collateral, same NOI, but now we right-size the loan to achieve our 10% debt yield. We get a 146 debt service coverage ratio and a 59% LTV. People say, well, yeah, but if you do that, you're giving up something. Yeah, you're always giving up something. You're giving up yield. But it's a more profitable business on a risk-adjusted basis, and it's a relationship play, and I'll get to that in a moment. But let's take a look at stress testing it. So how far does NOI need to decrease to get to a 100% LTV, assuming the same cap rate? Well, this loan, 26% in NOI decreases gets us to 100%. On the 10% debt yield, you can have a 41% decrease in the 135,000 NOI before using the same cap rates. Cap rates haven't moved before you get to 100% LTV. Lenders don't want to be at 100% LTV. 26% decrease in NOI is not a huge stress test if you look at variability of NOI on investor property or EBITDA on businesses. That is less than a 1 sigma event. Cap rates, where do they have to increase? So to get to 100% LTV, we're starting off at a 6% cap yield, or cap rate rather, on these properties. 8.1 on the first one gets us to 100% LTV. 8.1 is the historical average cap rate for all properties across the nation. This 10% debt yield, cap rate needs to go up to almost 10%, well above the average cap rates. Where does the loan rate need to go to get us to one-time debt service coverage ratio? Well, the loan rate here is 475. 200 basis point increase gets us to 1% debt service. So 200 basis point stress test, the regulators want to see 300. On the 10% debt yield, we've got rates have to go up by more than 300 basis points before we're at one-time debt service coverage ratio. Obviously, this is the superior loan. It's a relationship credit. And the M period, a lot of banks are taking liberty now with the amortization period. They're doing 30-year AM, but they're also adding 2 or 3 year interest only in the beginning. Sure, you can get your debt service coverage ratio to meet your 120. But if we do the debt yield calculation and we say, where can the AM period go before the debt service coverage ratio falls to 1? On this loan, the first loan, we go from a 25-year AM to 19, and this deal doesn't cash flow anymore. It's below 1. This deal can actually cash flow at 14-year amortization period. Not that many real estate deals are written, but the capacity to repay the debt is superior. Banks that we work with that are relationship driven will sacrifice yield to get better credit quality. Unfortunately, many banks only underwrite loans to 2 buckets. So if you're a bank and you have 9, 8, 10 buckets, 4 of them are pass grade, 85% of your loans are in only 2 buckets, and the distinction is not granular enough to be able to decide which loan you should do on the credit side. Okay? So that's the credit component of relationship. I'm going to tie in why it's important. Okay? Okay, let's talk about enhanced service, because I talk to 100 banks per month, and 98 of them will tell me that they offer above average service. And I'm no dummy. I took statistics, and I know that's impossible, because no one can be, not everyone can be above average. Someone's going to be above, someone at, someone below average. Okay. So how do we provide service to retain these relationships? And who do we provide the service to? First, in order to provide service, because you can't be all things to all customers. You just cannot offer your service to everybody. But first, you need to decide, why do you want to provide the service? And to make customers happy doesn't make any sense, because only 10% of our customers are actually profitable for a bank. The other 90% actually don't deserve our service. They deserve to either be migrated up into a profitable segment or be shown the door gently. But you need to decide as an organization why you want to provide superior service. Is it to build market share? Is it higher profit? You want to grow the bank? Is it to reduce the cost of delivering? Is it customer loyalty? All of these things will provide a different answer in how you provide service and who you provide the service to. And the who is it every loan? Is it a $100,000 loan gets the same service as a $10 million? And product usage. Does it mean that a customer that only has a $1,000 checking account, do they get the same service as a customer that has 14 million in DDA deposits and a $4 million loan? And is it across your whole geography? It certainly shouldn't be across all credit quality. There are many credits that are actually negative risk-adjusted return on capital on the balance sheet. Certainly don't want to develop a high level of service for those. You may want high level of credit scrutiny, but not a high level of service. We also want to survey clients, and you can read this on your own, but I'll give you an example. You ask your clients if they would like to have your branch open on Saturday, 98% of them will say absolutely. You ask the same clients, will you use the branch on Saturday? About 95% will say, no, we're not going to use it on Saturday, but it doesn't cost me to have your branch open. You know, I'd like to drive by and see it open. So we need to find out what clients want, and more important, do they actually value it? So if we're going to identify a service, so this panel here, we want to make sure that we're getting compensated for the value that we're creating. So if it costs us $1 to provide the service, we want to make sure we're generating more than $1 in profit on that service. The client expectation is important as well. We may say we want to deliver service, but where does that service need to be? Do we need to close and fund a loan in 3 weeks, 3 days, or 3 months? I work with banks that cannot fund a loan in 4 months, and I think that is inferior service. I'll work with banks that can fund a loan within 4 or 5 days. That's extremely fast, 4 or 5 days. And that perhaps is service that they don't need to deliver because borrowers don't expect it. That's not the expectation. But somewhere in the middle, we need to decide the borrower's expectation and how we deliver on that service. So on service, define it. It has to be meaningful. You got to measure it. You got to set your goals based on client's expectation. And you want to motivate the providers of that service by offering incentives and a stick if they don't do it right. So I know many banks that pay lenders based on volume. Some banks pay lenders based on fee generated. A few pay based on risk-adjusted return. Very few banks actually motivate deposit gatherers or lenders on the service they provide, yet everyone hones that their service is superior. And then I want to make sure that we don't have selection bias. This is really important. I've dealt with many banks historically that say we provide great service. I said, but you're providing it to negative ROE customers. You want to make sure that if you're providing service and you cannot provide it to everyone equally, it's for the client that is profitable. If you remember that gradation that at CenterState, trucking not as profitable, accountants, professional services more profitable. Where do you think we're going to allocate our lender resources? To the profitable business. Okay, let me pick up the pace just a little bit and talk about differentiation. Okay, what is offered, how it's offered, the features and the perceived value to your relationship accounts. Okay, so that's our base slide. Let me go and cover it. Okay, I'm only going to have one slide. Here's how we decided at correspondent division we're going to measure our differentiating positioning versus the competition. We're going to look at responsiveness. How quickly can we provide a decision? How quickly can we get a commitment letter? How quickly can we get documents? How quickly can we close? How quickly can we fund? We feel that's important. That could be a differentiator for us. So here's our bank. It could be your bank. And we want to compare ourselves to the host of other institutions that also are in the lending business. So I say crazy. Some people say it's not PC. I don't know if I should crazy, stupid. The other bank down the street, credit union, the conduit, the national bank's insurance company, government agency. So we try to differentiate in our responsiveness. Influencer. Can I walk in and talk to the person who's going to make a decision? That's important for many borrowers. The local connectivity or nexus, very important. And so at our bank and other banks as well, it just depends which bank you're dealing with, the ability to come in and whoever's got the $2 million pen or the $10 million pen to be able to approve the credit, be able to talk to them and explain what you're doing. Flexibility. Okay, now this is important. Do not view the market through a straw. And I tell borrowers this all the time. I know that everyone is stumbling all over your 120 debt service coverage ratio, 80% LTV, pro forma numbers. Every bank wants your loan today. Don't get bogged in. In today's market, everybody wants a loan. In 2008 and 9 and 10 and 11, nobody would touch you. And the economy is improving, but guess what? We haven't repealed business cycles. The economy will slow down again, and there will be another recession, and many of the lenders that are now calling on you will retract. My bank will not, because we're looking for the right credit quality. Remember we talked about the debt yield? We want the 10% debt yield. We've got cushion in that deal. If you're having problems, we started off at 60% LTV or 65. We didn't start off at 80. I've got lots of room to help you out. The other bank down the street that started at 80%, they're not a relationship. They will yank that loan at the first moment of weakness in your performance because they have no wiggle room to work out. And so relationship banking is not about the highest advance rate you can get. It's actually about lower advance rates. And that's the flexibility we can offer. And if you want to move your loan and if you want to transfer it, we'll talk a little bit more if we have time on that. Continuity. We position ourselves saying, look, we're in Florida, and so you could go to Wells Fargo, but recognize Wells Fargo's across the country. Fine institution, nothing against them. But if Florida is not doing well, and obviously your bank, you insert your state you're in, but you're in Texas, you're in South Carolina, your client is there. If those states are not doing well, guess what we're doing in the state? We're still there as a community bank. Wells Fargo, B of A, they may just pack up and leave. And so as a borrower, if you want a transaction, you may go to those other institutions, knowing that that institution may not be there for you when Florida is not doing well, or South Carolina or Texas. But we're a relationship bank. You're in Florida, we're in Florida, we're going to stick with you. So that's how we differentiate from competition on the relationship scale. Okay, I don't have time to go through all these case studies, which is a crying shame because they're all really interesting. But I'm going to go through a few of these. Okay, construction versus perm financing. So what I'm doing, I've got 6 case studies. These are deals that I've been involved with, I know intimately, that I want to convey to you of how relationship matrix that we've been talking about, the decision making, how it drove a particular bank to choose a particular structure or a particular client. Construction through perm. We were dealing with a bank, community bank, in I think it was Maryland, may have been Virginia, and I was talking to the CCO and the COO. It was a $2.1 million multifamily construction, and the 3 of us were talking about whether the bank should offer construction only for a year, the construction plus the 1-year interest only to help the borrower stabilize, the mini perm to give them 2 years after the interest only, or give them a full 20 years at the end. And the CCO said, well, you know what? I'd like to know what's happening with my credit. So let's do a 1-year construction. And if things aren't going well, I want to pull out, right? So I'm going to do, multifamily, nothing's pre-leased, right? There are no tenants waiting to take the building 12 months from now. So the chief lending officer said, well, hold on. In a year, if the economy tanks, or there's a lot more supply in the market, wherever it was, Annapolis, wherever it was, and the borrower cannot get the tenants, we've got a problem, but what are we going to do with this problem? Rates could be higher. We've got a TDR. We've got to give the borrower more room to be able to lease out. CCO said, okay, we'll give them 1-year interest only, but that's it. Well, what happens after that 1 year? If they still can't lease it out, what are we stuck with? If the borrower, who's a professional manager, cannot lease the space, we as a bank, do we want to step in? Well, we ran all 4 options. The construction, which is a 1-year commitment, the then interest only, which is a 2-year commitment, the mini perm, which would be 3 years and 4 years in total, because it's the first 2 years plus 2-year takeout, or we could do the 21-year commitment totality. And so the problem is in doing the construction is you're taking all of the risk with no revenue coming in yet from the underlying collateral. The ROE is negative. Okay. Now, the interest-only period, you assume your probability of default goes down. Your revenue goes up substantially. Why? Because you've got more time, but you've got a lot more outstanding. On a construction, it's multiple draw. You don't have all of it outstanding. Your probability of default starts going down much later, and your revenue goes up much later. So on a 20-year deal, you can generate $1.7 million in revenue. On a construction loan, you're only generating $57,000 in revenue. Guess what? Your probability of default is much higher in the beginning, and you make more revenue through the life of the deal, and your probability of default, when you average it out on a 21-year deal, you still have the probability of default you lived with year 1, but then you have the much lower probability for the last 20 years. And that is a huge advantage to a bank. So is the construction loan a relationship? Well, no, it's not. In and of itself, the borrower will take the construction loan, the deal stabilizes, they're going to go elsewhere to another bank that might offer them a better coupon because now the risk is lower. Some other bank values the relationship, and that bank will lock in the client for 10, 15, or 20 years. So here's an example where choosing the right structure for the loan can either lead to a transaction or a relationship. Okay? Let's quickly just take a look at loan size and how that drives relationship value. So here is one loan, same loan. The only thing that changed in our risk pricing model is the size of the loan. Look at what happens here. Loans cannot be profitable at commercial loans with the average bank's underwriting overhead commercial loans cannot be profitable below a certain size. And typically that size is 100,000. For some banks, it's 250,000. For smaller banks, it could be as high as 500,000. So underwriting a $500,000 loan, regardless of the coupon that you get that's market driven, those loans are not profitable. When you look at one bank and all 4,200 commercial loans and you spread them on a size to ROA, you see that the smaller the loan, there's a huge relationship between size, small loans, tank, and profitability. Okay? Let's consider what a sticky relationship is, and I think for the interest of time, we're just going to call it at that. The other ones are really fascinating, but let me just cover number 3. What is a sticky relationship? That everyone says, well, relationships are sticky. We want them to be around. How do you get that relationship to stick around? Okay. First, there are prepayment costs. And there is a friction cost, and the friction cost is, what is my cost of going to get a new loan? So I'm going to have to pay appraisal, legal. I have a switching cost. What does that mean? Well, I've got treasury management that's tied in, or I have a relationship that I have to sever in the community. Whatever it is that's at the existing institution is your switching cost. And most importantly, the contractual cost of a prepayment provision. And I was on the phone this morning with a borrower who was arguing that they don't want a 5-4-3-2-1 prepayment provision, but they're willing to live with this symmetrical prepay. And this is, to me, it's hilarious because I deal with banks across the country. They say, well, we cannot get prepayment provisions in the loans. And I say, at CenterState, we get them all the time, but we use the right one. We use the one that actually makes sense for the borrower. It doesn't matter what you want. It doesn't matter that you want a 5-4-3-2-1. You have no cost of the borrower prepaying that you can equate to 5-4-3-2-1 that the borrower would pay. In other words, you may want to charge 5% in the first year, 4% in the second. The borrower looks at you and say, what's your cost? And as a lender, you say, well, I can't really explain what my cost. I say, well, then I'm not paying it. At CenterState, we sell this prepayment provision, symmetrical prepay, all the time because it drives relationships and it makes sense for the borrower. And I'm going to quickly describe it for you. 25 do 10. We start off at a market-driven rate down the middle, and we say to our borrower, look, we're going to offer you, because we're relationship-driven, that we want to give you a 1-year deal? No. Do we want to give you a 5-year deal? Also no. We want to give you a 10, 15, 20. We want to lock you in. We wouldn't say that to the borrower. We wouldn't use the words, we want to lock you in. But at the back of my mind, I want that relationship for 10, 15, 20 years. I want to cross-sell. I want to upsell. And then I say to the borrower, look, but you choose the commitment term. I can't force you into a 10-year. But if you do, if rates are higher, you're actually going to get a fee. So 2 years into the deal, you're going to make $15,000 of prepay. Do borrowers prepay when rates are higher? No, they don't. But if they did, we would pay them a fee. If rates are lower, the borrower has to pay a fee. And that fee is nothing other than the amount that they would save, $15,000 and change, 2 years into a deal. Our loan rate starting, the market rate decreases by 25 basis points. The new loan that the borrower can get in the market is 25 basis points lower. If the borrower goes elsewhere to get the advantage of lower rate, we would charge them exactly how much they would have to pay us to get out of that arrangement. We've now created a point of neutrality. Borrowers don't want to leave CenterState. And this program that we offer, we've been able to cut our prepayment rate, our speed of prepay, to less than 2% per annum. And that is hugely beneficial to relationships because now you have borrowers that stick with you. They start off at $1 million loan. You can upsell to $2 million as their business increases. I am out of time, and I'll send you the slides. Whoever wants to see them in other relationships. Do we have any questions, Patrick, on the line?
Hi, it's Hillary. We didn't
Hillary?
have any questions come in, and that's probably because we went over a little bit. But the good thing is we will be sending out your PowerPoint with all of the slides, and also your emails included in that. So any questions can come your way if that sounds good to you.
It does. Thank you, Hillary.
All
Appreciate it.
right. Well, thank you so much. And like we said, we'll be emailing out the final webinar and the slides. Ed, thank you so much for being part of the MountainSeed webinar.